The alternate version of Quick Study 410, we're asked to prepare year-end adjusting entries for estimated future returns and allowances for ProBuilder for its first year of operations ended June 30th, 2016. New recognition policies require us to record these adjusting entries. Now there's going to be two separate sides. The first one is going to be an adjusting entry to record the sales expected to be refunded. Keep in mind, ProBuilder, according to the scenario, had total sales this year ended June 30th, 2016 of 100,000, but it estimates that 3% of those sales, or $3,000, is expected to be refunded to customers. So that's something they expect to happen in the future. Where we need to start with is, what do we currently show on our books right now is the expected amount to be refunded? Where we would find that is in the liability account, sales refund payable. This is a liability account. It represents our expected future obligation to our customers, the amount we expect to refund to them. Right now, it's our first year of operations, so we don't have anything. So currently, there's a zero credit balance within our sales refund payable. So zero. Our second step is, what do we want that account balance to be equal? And that's where we're going to have to do a little bit of work. So the adjusted balance of what do we want it to be is our $100,000 of sales multiplied times 3% of it is the expectation of what we're going to refund. That comes up to be $3,000. 100,000 times 3% is $3,000. So that's the amount that we want the credit balance to be in sales refund payable. So what do we need to do in order to get it there? Let's start to build our journal entry as of June 30th. In order to get it there, we're going to have to credit sales refund payable for $3,000 so that we have a $3,000 balance. Again, if it wasn't the first year of operations, we may not necessarily be so lucky. What if a credit balance previously existed in this account of $1,000? Well, then we'd need to only credit it for an additional $2,000 to get it up to that $3,000 balance. Being it's our first year of operations and it's zero, we're going to have to credit it for the full $3,000. So the first part of our entry is to credit sales refund payable, again a liability. In fact, it's a current liability, something expected to be refunded to our customers within that 1 year time frame is going to be a credit of $3,000. What's the other side of our entry? The other side of our entry is very much the same as if we were actually refunding a customer. So in an actual refund, instead of debiting sales, we debit the contra revenue account sales returns and allowances. So we're going to do the same thing here. Debit sales returns and allowances for $3,000. Again, since this isn't an actual refund, we can't credit accounts receivable because we don't know who exactly we were going to refund. If we knew who was going to get bad product or have problems, we certainly wouldn't sell it to them. So we're going to credit the liability account sales refund payable. And that's our first part of our entry. Our second entry is going to be related to the cost side of sales returns and allowances. So we've covered the side of what we think we're going to refund to the customer. But keep in mind, we're selling a tangible item. We expect some of that to come back. We can put it back into inventory and we can resell it. So we also need to factor that in. So again, let's think about what's that current balance right now, because based on where it is now, we've got to think about where we need to get it to and what difference that is. So the account that looks at the estimate of the returns, the inventory that we're going to get back in, is a current asset account called inventory returns estimated. In fact, it happens to be at a zero balance only because, again, this is its first year of operations. Inventory returns estimated is a current asset account. So as an asset account, it's going to have a normal debit balance. Again, it represents not inventory we have on hand, but inventory we expect to be returned from our customers. What balance do we want it to be? That's our second step. Well, we can look at the fact that we had $40,000 in cost of products sold. We expect $3,000 or excuse me, 3% of that 40,000 to be returned. So 40,000 times 3% is going to be $1,200 or $1,200 is what we expect to be inventory return. That's what we want the debit balance to be in inventory returns estimate. So what do we need to do in order to get it from a current zero balance to a $1,200 debit balance? We need to debit inventory returns estimate, again, a current asset account. We increase it with the debit by $1,200. Again, would be a little bit different. If we had a current balance in here of already a $1,000 debit balance, we would only need to debit it for an additional $200. So you've got to look what the prior balance is. Well, what's the flip side of the entry? So very similar to what an actual return would be. Again, this is an estimate. Our flip side of our entry is to reduce the expense cost of goods sold. Ultimately, this product is expected to come back and reduce the expense cost of goods sold, so we credit it for $1,200.